Understanding money is one of the most important things someone could understand in life.
The global financial system has been broken for developing countries, especially throughout modern history, but also for developed countries.
If everyone just has accounts at a bank, the bank just has accounts at a central bank, and the central bank's holding the gold, then literally with a stroke of pen, you can say, well, now this many currency units is a different amount of gold. Almost every friction in finance was solved by more and more centralization.
The European Central Bank is now deep into its pre-launch phase for what they call a digital euro.
This is kind of the ultimate end state of fiat currency. Instead of just surveilling everything on the bank level, they can surveil everything on the individual level. 160 plus currencies in the world, and everyone has a pretty tight monopoly over their borders. And now anyone can bring dense value with them by memorizing 12 words. And there's no one that could stop me from sending Bitcoin.
Hi, Lyn. Thank you so much for being with us in this new episode of the podcast by the French National Bitcoin Institute. I'm Alexandre Stachtchenko, the president of the institute. You are the founder of the research firm Lyn Alden Investment Strategy and call yourself a blend of finance and engineering with a focus on the intersection of money and technology. We're together for a special occasion, the release of the French version of your bestseller book, Broken Money, for which I had the honor to write the foreword, and I hope can bring your unique perspective about money to the French audience. So, Lyn, thanks again for being with us today.
Thanks for having me, and I'm excited that the book's able to be in France now, within the language and everything. So hopefully it can reach a new audience. Excited for it.
For listeners who don't know you yet, could you tell us a bit more about yourself and your background, and how did your path lead you into macroeconomics and eventually writing the book Broken Money?
Sure. So when I was growing up, I was interested in both tech and finance. When I was time to go to university, I decided to go into engineering, so I chose the tech side. And then I spent well over a decade in the aviation simulation space, starting off doing engineering, electrical engineering, and then going into engineering management, running the finances of the tech facility, that kind of thing. On the side, I continued to be very interested in investing. From 2010 to 2015, I published a blog on stocks. I eventually sold that to a larger publisher. And then in 2016, I founded Lyn Alden Investment Strategy to take a somewhat broader view of markets. And initially, I kind of stuck to my roots of equity analysis and things like that. But then I kind of realized that we were entering a very macro-heavy decade, if not longer. And I also made the connection that basically the way the global money system works is very much a system. And my background at that point was systems engineering. So understanding a system that is more complex than any one engineer knows. So you have a team of engineers building something complex like an aircraft simulator, which has everything from avionics to mechanical systems to optics to, you name it, aerodynamic models, things like that. So it's kind of like understanding how a complex system works and understanding specifically, because I did electrical, the control system. So all the hundreds of inputs, like signal inputs, signal outputs, the governing logic for how that system works. And I basically applied that to macro, which is to say that there are these big human designed systems and things flow around them in a similar way that they flow around in engineering systems. So I try to bring that insight to macro analysis, and then just kind of exploring that intersection between technology and finance, which is kind of finally marrying the two sides of my background and my interests.
From a methodological perspective, how do you manage to not cross the border between having a systemic holistic view and have the temptation of seeing the world as being monocausality, so saying that one thing is the cause for everything, because it's always a very blurry border between the two methodologies.
I mean, I think I try to consciously push back on stuff like that, and I always try to test my theses. If someone has this kind of like this one thing is responsible for everything kind of mindset, then they tend to interpret everything as though it feeds into that initial point. Whereas the other way to do it is more consciously always test your point and see if it helps explain what's happening now, and then two, to see if it gives you predictive power. So rather than just interpreting things in hindsight and saying how like your initial point is why that happened. It's basically to say, does having this thesis give me an above average ability to predict events that are related to this thesis? And then just to acknowledge that there are some things that are just entirely separate, that the world's a complex place. And so I try not to have opinions on things that are just entirely outside of my knowledge set. And I focus on the handful of areas that I tend to have built up experience and some degree of predictive power with.
Yeah, the question is not innocent, because especially in the Bitcoin ecosystem, there might be some people who say, and I think there's some truth to it, that some Bitcoiners have a tendency to bridge the gap and start having that monocausality and say, well, if you fix the money, then everything's going to go well, because this is the only problem in the world. But it's interesting to take a step back and have a bigger perspective on what is money, and that's where your book is very helpful, because it brings a perspective, a historic perspective from a technological point of view. That's what you're trying to bring in the book. So going to the writing process before we go into the content of the book, what was the process like for you? Because you spent years diving into monetary history and technology, whereas your background initially is in electrical engineering and system engineering. Did anything in your research surprise you or force you to change your perspective while writing the book?
So most of that, by the time I was writing the book, I had mostly finished the bulk of the research because I had been writing these really long form articles in the years preceding the book. And so that's where a lot of the initial research was. And so from 2017 up to 2022, I had been writing a ton of articles. Some of them were like as long as short books on the subject. Um, and I would talk about these kind of different macro topics. Um, and I resisted writing a book because writing a book is a very tedious process, low ROI in the most case. And I didn't want to just write a book for the sake of writing a book. So I kept resisting writing a book. It was especially from 2020 to 2022, it was a very fast moving market. So I wanted to get articles out the week that I wrote them. And there were all these debates at the time. How does the money system work? What is the relationship between broad money and base money? I would kind of debate with some of the leading experts that were on kind of the opposite side of how I viewed certain things. So we'd kind of test our ideas against each other, sharpen our swords, be able to articulate the other side of a given argument, and therefore know how to counter it, kind of deconstruct it, and write kind of point by point why that the camp is incorrect on a certain topic. That was very helpful. And by 2022, enough themes kind of fell in place from all those years of research that a book formed in my head. And at that point, it was distracting not to write it. And so it's like I had to write it, didn't really have a choice. That was like the thing that got me into the flow state for the next year. So from 2022 until mid 2023, I was writing and editing the book. And at that point, I did more rounds of research to fine tune the argument, especially for a book format. I also had the benefit of Joachim Book as my editor and research assistant for the project. So Oxford trained economist and monetary historian, which is kind of the perfect editor to have for a book on this topic. So he would help me kind of look into resources that I wasn't aware of, or sometimes he'd push back on a given topic, so I'd have to, tweak a topic to make sure I'm phrasing it correctly. And so we kind of went through that process. And the goal was to make a book that is near academic, but not fully academic, which is to say that there are some academic books out there. There's Resistance Money, a great book, and then there's a new one, Bitcoin Principles. These are published by academic presses. The challenge with those types of books is that the pricing is different, and they also tend not to sell very much. And I wanted to reach a broad audience, retail investors plus institutional investors. And so I tried to make a book. I mean, there's 400 citations in the book, over 400. The goal was to make something that's kind of academic quality, but geared toward a broad audience. And that's kind of the focus there.
Yeah, and I think perfectly on target concerning my point of view, at least on the book. Going into the content, so you we're gonna go through just several key points of your book and let the audience, of course, discover the whole content by themselves. But you present an interesting idea, what you call a unified theory of money. Could you explain what that means in simple terms, and how you are combining multiple views of what money is into one framework? So essentially, what makes your theory of money unified, and why did you feel the need to establish this framework?
So there are kind of two main schools of thought on money in academic circles that I've generally found often talk past each other. And so I wanted to explain how they're kind of two sides of the same coin. So one of the camps is commodity theory of money, that basically, money emerges as a commodity, and then, we build systems on top of it. And that's the camp that, on average, I generally fall more into. But there are certain incomplete aspects to it that I felt were not being mentioned in books on that topic to compete with the other school of thought. So the other school of thought is the credit theory of money. That's where the MMTers get their kind of view from, and that goes back. The most popular book on the subject is probably David Graeber's Debt: The Past 5,000 Years. But he actually, I mean, the initial source, I would say, the most kind of mass market source was Mitchell Eanes. He wrote essays on this topic back right around World War One in the early 1900s, and those were. I mean, I disagreed with a big chunk of them, but those were great essays on the topic. And then before him, it kind of went back to the late 1800s. This credit theory of money or the state theory of money, they're kind of those are kind of two like tied together. And there were certain aspects that they would point out about the commodity theory of money that didn't align with history very well. And so I kind of focused on the fact that they were basically two ways of measuring a ledger. So commodity theory of money basically lets nature measure the ledger. So nature dictates how fast you can, for example, mine gold and silver, and updating the ledger is as simple as, changing physical ownership of that gold and silver. And it's basically, if you kind of zoom out and look at it from like an omniscient point of view, it's basically this ledger being updated, even though no human has a full mental state of that ledger. That ledger still objectively exists. Whereas obviously a credit theory of money or a state theory of money, it's a more literal ledger. Like it's literally, in a series of bank ledgers or a central bank ledger and kind of a nested series of ledgers.
It's formalized basically.
Yeah, it's formalized. And so my kind of view was to say, well, what is money? It's basically this ledger, one way or another, that people are deciding or being forced in some cases to use. The earliest time I heard that reference was Wentis Casares mentioned it in a series of talks he did a little over a decade ago. He didn't really go into detail on the subject, but he had mentioned it. Also, Gigi wrote really good articles that kind of touched on the topic, like Bitcoin is Time was a good article that he wrote on adjacent to the topic. And so there were these little kind of like micro impressions on that, and I wanted to kind of, I kind of wanted to fully explore that notion and kind of speak to commodity theorists of money in a way that credit theorists would understand, and vice versa, to try to give people a more holistic view and kind of increase the crosstalk between those two camps.
And by presenting a unified theory of money, also it allows you to speak to everybody, so that everybody can actually have a holistic view on the rest of your book and the theory that you're
that's the goal,
offering.
yes.
Yeah. So apart from the theory, let's say about money, one of your key arguments is that and that is a specific chapel, let's say, in the history of money, but money predates the state and tends to emerge bottom up from the interaction of people rather than being created top down by government, which is mostly linked with the state theory of money. Why do you think it's important for people to understand that money arises naturally among people, and what are the let's say historical evidence that you share to show that money can develop organically without a central authority declaring it? Because I know you share in your book, of course, very old examples among hunter-gatherers, but also some video games example that show the same thing.
I think it's because, I mean, understanding money is one of the most important things someone could understand in life, because it's on one side of every transaction. So it's one of the most important topics in economics, and economics is one of the most impactful topics for someone's life. So going back to the prior point, there's no one single thing that's most important to learn in the world, but if you make a top 10 list or a top 20 list, understanding things about money is I would say somewhere
We'll
near the
make
top.
it to the ranking, yeah.
Yeah, it's a pretty high ranked thing to understand. And so if people have very kind of incorrect views on money or views that don't align with reality or won't serve them well, then they're disadvantaged. Then there's also kind of concerted efforts by some groups to rephrase what money is in their advantage. And they'll kind of exclude facts that don't line up with that and include facts that do. And so I think it's useful to say, well, here's some facts that disagree with that point of view. Basically, a state saying that only states can create money or things like that. And it's also people would make the argument that money can be arbitrary, that it's anything we decide that it is. But of course, in reality, certain monies have different traits that allow them to outcompete other types of monies. And it's not an accident that, say, gold is more reliable money than paper clips, for example. It's just, it's not like the whole world can decide to use paper clips because it only takes a handful of people to start exploiting the fact that paper clips are not scarce, they're not good money, and they can, screw over everyone who mistakenly thinks that they are good money, that money can be chosen arbitrarily. And so these properties of money tend to emerge regardless of top-down influence. And then even in the extent that top-down influence does create a money, there's often a series of technological changes that occurred that put the ball more in their camp to make that more possible compared to other eras.
So yeah, you talk in your book about what you just said, which is that there's money, and there is what makes a good money. What makes that a thing becomes money organically, and it cannot be paperclip. It's gold, more historically speaking. And you bring back some of Karl Menger's key characteristics of money, like sellability, durability, liquidity, etc. But you add one, which is transaction speed, and that's where you bring, I think, your technological angle, let's say, point of view in the book, and you argue that in addition to those, let's say, classic traits, transaction speed has become a crucial new factor in modern money, where in earlier eras, moving money like gold or silver was limited by physical speed, but today transactions happen, nearly at the speed of light. So, especially you mentioned the advent of the telegraph in the U.S. as a very like world order changing moment in the history of the world. How did the advent of those technology, and especially now also near instant transaction technology, change everything in finance and add a new characteristic to what makes good money? And maybe last question of this very long question, but what problems or imbalances arose from the fact that we could suddenly trade value faster than we could actually settle it physically?
Right. So prior to the mid 1800s, when the telegraph was invented and deployed, all monies had similar speeds, which is to say that you could transact gold as quickly as you could transact shells, for example. And there are certain technologies like coinage and the printing press and banknotes and stuff that would make transacting any sort of physical commodity easier. But basically, all of it was limited to the speed of matter. And so monies mostly competed on durability, divisibility, these types of things. And so whenever shells or cocoa or tobacco or copper, whenever these things went up against gold and silver won. And those were the two kind of dominant monies for thousands of years because their properties outcompeted the others. And anyone choosing the wrong sort of money would eventually get debased and kind of just
Wiped out.
impaired
Yeah.
compared to those holding better money. And what changed is that with the invention of the telegraph and specifically the deployment of it, so cross-Atlantic telegraph cable was 1860s, cross-Pacific telegraph cable was early 1900s, and of course we added telephone, we added radio, we added internet, so this only sped up further from there. But basically that was the point where, especially between Europe and the United States and across Europe and across the United States, transactions could now move very quickly. They could move at the speed of light because it's as simple as making an IOU. Whereas the physical movement of gold was still slow. And so we kind of created this massive mismatch between transaction speed and settlement speed. And the way that was solved was through someone running a ledger to say, okay, well, we're going to net out all these IOUs, and very occasionally we'll settle with gold if needed. And so everybody became kind of reliant on certain ledgers. So it'd be a bank ledger, and then banks would tie into deeper ledgers like central bank ledgers. And that basically shifted power to those who had enough scale and force to run those ledgers. Whereas physically transacting a commodity with someone else is inherently a more decentralized process. If you're beaming value across oceans and across continents, that requires scale, infrastructure, and there are generally those in power that control that scale and that infrastructure. And so that really kind of shifted the power balance toward the state direction of money, because it's easier to capture a handful of banks and infrastructures and kind of dictate how that's going to run now compared to physical exchange of value. So as the global economy sped up, as we entered the telecom age, speed became a new variable for money. So for thousands of years, it was just kind of durability, hardness, divisibility, and now they said, well, I mean, we have to be able to transact value very quickly, and even gold's not cutting it anymore. And that's what allowed kind of the state-issued monies, especially the UK pound and the American dollar, in different eras, to actually directly compete with gold, and in some cases be chosen either by force or just by market forces over gold because it blended some degree of stability with that speed. And so it kind of shifted the power balance and changed how we use this money. And the disadvantage, of course, is centralization, which is to say that almost every friction in finance was solved by more and more centralization. So if I want to transact with you, instead of doing it physically every time, we can just have accounts at the same bank, and I can just tell the bank to send money to you. If we're at different banks, then our banks have to communicate somehow, and it's easy for them to just plug into a central bank and just, if I want to send money to you, I just tell my bank, and then they tell the central bank to shift over to your bank, and then that allocates it to you. And then if we're in different countries, as we are, generally speaking, they tie into even a deeper ledger, like kind of whatever the global reserve currency is at the time, either directly or indirectly, kind of serves as the master ledger. And so we have a kind of a nested series of centralization, and that is prone to more debasement. It's prone to selective money printing, so you kind of increase the monetary base when it's useful, and you can direct it to those who have influence and power, for example, or it can be spent in other ways. And this kind of just changes the dynamic of money pretty significantly. And the reason that's kind of an interesting topic is because Bitcoin is kind of the invention of fast settlement. So it's the first time where that speed mismatch between transactions and settlements is closed again. 1800s opened that up, and of course, sending Morse code is a lot easier than sending final value. We needed a lot more bandwidth. We needed more encryption and math figured out. We needed more processing power. All these things had to occur until there was a workable system that could actually, in some ways, manage a settlement ledger globally at the speed of light. And so we're kind of finally entering in an era where that gap might be closed.
So your the situation you're describing, especially the transition that we've seen in the 19th and 20th century, is that the situation that you're describing with the title of your book, Broken Money? Because you're saying that the global financial system has been broken for developing countries, especially throughout modern history, but also for developed countries because they face imbalances that we're going to talk about a bit later. So is this the broken money situation we're in? Is the inheritance of this imbalance between the speed of settlement and the speed of transaction?
I think that's the root cause, yes. So it's not that that was the invention of debasement. I mean, debasement's going back to the Roman Empire and before, but if you look at that, the speed was very slow because you couldn't just teleport all the money to you and then debase it. You had to literally bring it in with taxes or other measures, remelt it into, debased coins, and then spend it back into the economy. So there's inherently this kind of slower process with doing that. Whereas if everyone just has accounts at a bank, the bank just has accounts at a central bank, and the central bank's holding the gold, then literally with a stroke of pen at night, you can say, well, now this many currency units is a different amount of gold, or it's not backed by, it's not, we're temporary or permanently suspending gold redemption for it, and and then you can just print a lot of money, so you can do that debasement over days and weeks rather than months, years, and decades, and so that's kind of a persistent power shift, and a lot of people focus on when they focus on the history of money, they'll focus on decisions. For example, the decision to make the Fed, the decision to make the Bank of England, the decision by this president and this Congress to do X, Y, Z, and those all matter. And yet they matter on top of this overlay, which even allows them to make the decision in the first place. Because if you're not even capable of making a decision, you're not going to be able to make it. Whereas if the power is kind of handed to you, and then you're more prone to making it. And so I think that technological aspect is more at the roots of how money ended up versus just human decisions.
So you're saying that those decisions matter, but basically they're mostly manifestations of a long-term trend that allowed the decision to be made in the first place, because the willingness to make such decision was not lacking before the 19th century, and anyone who could actually debase the ledger would do it. But the speed at which you could do it and the easiness with which you could do it changed the whole game of the let's say the global monetary order. And we were talking about the fact that it's particularly broken for developing countries. So I'm following up with recent news. We learned on May the 6th that the IMF will begin the fifth review of Egypt's 8 billion economic reform program. So that's Africa's second biggest economy, which is currently facing a dramatic situation, undergoing a third structural adjustment by the IMF, and with its currency having lost more than 80% of its purchasing power in less than 10 years. So you have, so I'm talking about Egypt because you have a family in Egypt. That's a country you know quite well and spend some time in regularly. And most people in the Western countries, they don't have a single clue about what's going on outside of their monetary prison, let's say. So how is the situation in Egypt a manifestation of that broken system?
So that's an example of a country controlling a ledger, as most countries do. And generally speaking, the countries that are wealthy and that are near the core of the system, their main difference is that their debts are mostly denominated in their own currency. Most of their financing is internal. And so, and if you look at developed markets, the money supply on average tends to grow at 6 to 8% per year. Obviously, there are exception years like 2020. But
This has
if you
been the case since the 70s, right? Because before
yes,
that it was less, and even before that it was less again.
yes, for the most part, yeah, that money comes from the 70s. The funny thing is, if you look at, say, the 50s through the 70s, it was about the same, because at that point, most currencies weren't redeemable for gold anymore, and so gold, even though it was ostensibly backing the currency, it wasn't actually tethering it in any sort of way. So really, that number goes back to the 50s, and so that's kind of the broad money supply growth rate for developed countries. For developing countries, the average is something like 14%, but there's a very long tail and a very large percentage of them within either our lifetimes or our parents' lifetimes have literally outright hyperinflated. And ones that have not have generally had long, persistent periods of double digit or in some cases triple digit inflation. Egypt, for example, has been running at like a 20% money supply growth rate over a long term and even higher recently. They temporarily will kind of pseudo peg their currency to the dollar and then they'll break that peg, often because the IMF doesn't want them artificially pegging it anymore as part of these structuring deals that you mentioned. Um, and so, whenever the numbers are increased, it makes the arguments more kind of direct, which is just and kind of harder to ignore. So, for example, if you're in Egypt, and I go there every year, my second home is there, family and friends there. Um, every year in Egypt, the money supply is growing at like 20% or more per year. And so if you're holding cash Egyptian pounds, as many do, that's getting debased. If your wages are denominated in that currency, it's on the burden of the worker to try to get like a 20+%
Of course,
raise
yeah.
every single year, or their share of the ledger is decreasing, and others are increasing. In addition, the flexibility allows the leaders to kind of do projects like big infrastructure projects, and those can be measured in decades. And until kind of hindsight, it's hard for anyone to say whether that was a good use of money or not. So, for example, on one hand, they might build a nuclear power facility, which is probably pretty good for productivity. On the other hand, they might build a ghost city that took a lot of resources and didn't really boost the economy by any significant percentage. And so everybody's kind of ledger is being debased, and it's kind of tricky for them to get ahead. There's all this, if you're running a small business and prices and money supply is growing up by 20+% per year, you have to shorten your contracts. You have to keep renegotiating your contracts, so your overhead, your administrative overhead, and business complexity is way higher. All of these are killers of productivity, and there are billions of people in the world. So, I mean, Egypt's population is well over 100 million, but there are billions of people in the world with varying degrees of this problem. In developed countries like the U.S. or France, it's a more subtle problem. it kind of takes years to notice for many people. Whereas in developing countries, it's a more in-your-face problem, and it's partly because these technological realities gave this power to these centralized authorities, and it often gets handled poorly.
So it seems like we're actually not playing the same game, or we're playing a game where some people are playing by rigid rules, where they actually have to have some overheads, let's say, cost in terms of time preference, projection in the future, administrative costs, shortened contracts, and so on. And it seems like it's a never-ending problem, because you can't catch up with the biggest economies in the world if you have to, you're getting debased by half of your saving every 3 or 4 years. So this allows me also to funnel the topic to a more broader question with the current, let's say, situation in the world. So of course it's impossible not to talk about what happened on beginning of April. So 2nd of April 2025, President Trump unveiled a universal 10% tariff on almost all US imports, of course, plus much steeper country-specific rates up to, if I recall well, something like 145% on China, branding the date as Liberation Day. You've decided to give full access to Chapter 13 of your book, few days after Trump's announcement on tariffs. And Chapter 13 is called Heavy is the Head That Wears the Crown. And you describe a situation where what people call, and especially because the expression originates from France at the beginning, is an exorbitant privilege. The fact that the US has the US dollar as a reserve currency. Your thesis is that it's also actually an exorbitant price to pay for the USA. So why do you think your book, and Chapter 13 especially, may be handy to read and understand the complex situation that we're in right now? And do you think that the end of the dollar as a world reserve currency may be a good news for the US?
Right, so this is a reformation of the Triffin dilemma proposed many decades ago. It's kind of rephrased for the modern era. And basically, the being the world reserve currency issuer comes at amazing privileges and amazing prices. So the privilege is, backing up a second, the way it works is like there's four main aspects to the global reserve currency. One is international contracts are, for the majority of them, are priced in dollars. So if Japan buys commodities from Brazil, it'll often be in dollars, despite the fact that it's neither of their currencies. Also, cross-border lending, the majority of it is in dollars. So if an entity in France lends to an entity in Egypt, it'll often be in dollars, despite the fact that it's neither of their currencies. Euro is number two, but it's a distant number two compared to dollars, especially outside of cross-border lending in Europe. And then three, it's central banks and large investment funds around the world disproportionately have dollar-denominated assets to either backstop their currencies or to meet their liabilities for the aforementioned financing for when they need it. And then four, most currencies don't have very liquid markets between each other. So if you want to trade Korean currency for Egyptian currency, there's unlikely to be a very liquid market between those two currencies. So the dollar's on 90% of global FX trades. So you change Korean currency for the dollar and then the dollar for Egyptian currency. There's only a few other markets that have kind of liquid currencies. For example, the pound and the euro. There are a handful of others that make up that other 10%, but the vast majority of the time, it'll be the dollar.
It's kind of a for the audience to rephrase it. It's kind of the pivot. It means that any currency you want to go to from your own currency, you will route it through the dollar.
Exactly, yeah. So the dollar has all these purposes that are above and beyond other fiat currencies. And so there's this excess global demand for dollars and dollar securities. And what that does is that overvalues the dollar on a trade basis. And so Americans have this privilege where they have a lot of import power. Their import power is mostly in their own currency. So when they buy oil from Saudi Arabia, it's in dollars. Their ability to sanction any country is very high because most countries are using the dollar in some shape or form, and that's kind of the biggest trading network, and it gives them all these kind of power sets. The disadvantage is that America is a very large and diverse economy, and there are entities on the wrong side of that, even in the United States. And so the downside of that system is that because the dollar is overvalued, it's hard to manufacture things in the US. It's hard to, kind of produce lower margin things. Like we can still make media, we can make technology, we can do healthcare, we can do finance. These are all these kind of high margin, less tangible things. But anything with like tangibility and lower margins is much harder to do in the US. Not just compared to developing countries, but even compared to other developed countries like Japan or Germany, for example, or Taiwan, which has become pretty wealthy. Um, and so this problem results in decades of imbalances. The other way to phrase it is that so the whole world's using dollars for all those purposes I mentioned. The question is, how do they get all those dollars? How do they get those trillions of dollars that are out there floating around being used for all these purposes? And the answer is the trade deficit, the US trade deficit. So by overvaluing the dollar, we import more than we export, and that net flow of dollars out into the world allows the world to keep using that as their primary ledger, their primary pivot for all these different purposes. And so the downside is if you're a US manufacturer or you live in a manufacturing region, like if you work at a restaurant that used to be near a steel plant and then that steel plant went away, your restaurant's probably going to go away too, even though you don't work in manufacturing. And so there's been regional flows of wealth from the heartland to the coastal cities. There's been political changes around that, and it's kind of reached a point where the United States is kind of known for its military, and yet we can replace our missiles or replace our ships at a slower rate than many of our adversaries or other entities out there that have less GDP because they have a larger, more impactful industrial base because we've mostly deindustrialized ourselves on a relative basis. And so my argument is generally that these prices are now becoming a bigger burden for many Americans than the privileges that the United States gets from being that world reserve currency. And so this topic has been elevated from relative obscurity a decade ago up to the current administration's like number one priority. And I think they're going about it in kind of haphazard ways, but I do think that the problem that they're trying to address is real and increasingly needs addressing.
But you're also saying also recommending for the audience to read the May issue of your newsletter because you talk about those points quite in details. And you mentioned a point about the fact that the US is also trapped because if the US tries to solve that problem, then it creates also a problem where foreign countries, they have those assets denominated in dollars, and they're going to try to sell them if they need dollars. And if they try to sell them, then it's a problem for the US market. And so then the Fed goes on and creates that repo or credit lines for foreign countries, and then you go back into the spinning wheel forever and ever. So what we are trying, as you said, is that this issue came in light in the recent years because it was mostly an academic issue in the past decades, and now it's shaping as an independent topic some of the politics in the U.S. But we're seeing that President Trump is trying to at least publicly stating that he's trying to address the issue of the trade deficit. But it seems like he doesn't want to let go of the dilemma. He wants everything. He wants to keep the dollar as a reserve currency, but he also doesn't want a trade deficit. So he's getting, retaliations, especially from China, who said, we're going up to 125 tariffs and we stop the discussions. Of course, Russia is another BRICS that is completely now isolated from the SWIFT network and the banking system. Do you see this as he's trying to keep everything, but he could lose everything because of these retaliations? So could these retaliations accelerate de-dollarization in trade invoicing and as a reserve currency? Or do you believe, as other analysts, that de-dollarization is a concept that comes back, every few years, but never actually translates into reality?
So I think there's a mix of both. I think that de-dollarization is a long process because we're talking about arguably the biggest network effect ever, right? So any network effects are very difficult to disrupt, whether it's a social media network, whether it's a communication protocol, whatever it is. In this case, it's the global money system. And just like the UK took decades to really kind of lose its reserve currency status and become one of several big currencies rather than just like the by far the biggest, I think the dollar would have to go through a similar very long process. There's initial evidence, if you look at Bank for International Settlements data and stuff, that this really kind of has been happening since around 2020 or 2021, where there's been a very gradual de-dollarization and a little bit of a broadening of reserve currency usage. And actually, the kind of the proto version of my chapter 13 in Broken Money was an article I wrote in 2020 that started to kind of capture these topics. And so this process has been underway, I would say, for roughly 5 years. Very gradual, and there are certain things that can accelerate it. So, for example, sanctioning Russia accelerates it. Kind of doing these unilateral tariffs might accelerate it. We are seeing kind of outflows of the U.S. that are kind of reminiscent of emerging markets and things like that. And I do think that the issue, if they go after the trade balance without tackling the root issue, there is the scenario that you get kind of the downsides without any of the upsides. And the hard part is that whenever balances build up for this long, correcting them is always going to be painful. Like, for example, if someone only used their right arm for years and they build up like a really massive right arm and then their left arm is like wasted away, when continuing that has problems. Like, it'll probably give them back problems and pain and things like that, especially as it goes on and on. So they have to start to try to change it. And yet, when they do try to change it, it's going to be painful. If they start to lift weights with their emaciated left arm, it's going to be painful. If they kind of slow down usage of the right arm, it's going to waste away a little bit, and they're going to go through this kind of transition point, which is not quick and it's painful, and that'll make people kind of want to revert to how it was, even though how it was also gradually getting more painful. And so I think the U.S. has a multi-year, potentially multi-decade transition to go through, and how gracefully it handles it will determine how successful it is. And I think that the initial volley is not very graceful, let's say.
Yeah, because as you said, there's also a risk that you lose the reserve currency status because no one can trust the U.S. anymore, but you still have that imbalance that doesn't bring competitiveness back into the U.S. Specifically speaking. So in this scenario of accelerated de-dollarization, it's a complicated word. What second order effects might it have on global demands for treasury and U.S. borrowing costs? That's a first question, but also broadening the question to a topic that is less discussed, which is the role of the USD denominated debt for other countries, because many emerging countries struggle when the dollar is strong, because their debt is in dollar and it becomes harder to pay. So if the dollar weakens, do those debtors countries actually get a bit of breathing, like let's say inverse emerging market crisis that we had at the end of the second millennia? How significant is that effect, and could it change those countries' let's say fortunes in any meaningful way?
So that effect can be massive. The most recent example is the 2003 to 2007 period. We had a pretty significant dollar weakening cycle. We had emerging markets boom, and that's actually where the BRICS acronym was created, because those are the economies that were doing so well that they got their own name. And because it was like kind of like how in the past 10 years, if you were not investing in US mega cap stocks, you were kind of missing the main trade, and Bitcoin. They're kind of the two things that you could invest in, that kind of beat everything else. Whereas back in that period, it was like BRICS. If you weren't invested in BRICS, you were kind of losing out. And I do think that a dollar weakening cycle would give another round of release to those emerging markets, because instead of having their liabilities keep tightening, they'd have a period of their liabilities loosening, which allows them to run less restrictive monetary and fiscal policies, and allows their various entities to kind of have some breathing room and flourish a little bit more. And so I think that's probably the cycle that we're in now, but it'll probably be a bumpy road. And then the main question is, so whenever this happens in the past, there's only been two major dollar bear markets since the 1970s when the system came to be. In both prior times, all those countries would re-lever up. So they get the breathing room, and then they'd use that breathing room to hang themselves. So when the dollar would strengthen again, they'd get crushed. Now, over time, they got crushed a little bit less on average because they did build up reserves. So in the first dollar strengthening cycle in the 80s, Latin America got absolutely crushed by that. In the late 90s dollar bull market, Asian financial crisis, again, absolutely crushed. In this dollar strengthening cycle, the biggest ones like the BRICS actually held up pretty well, and it's mostly the frontier markets that got damaged. So the Egypts and a bunch of African nations got really impaired, and then some of the weaker, bigger nations like Argentina and Turkey, the ones that had kind of specific issues, their currencies got damaged. But the biggest ones like China, India, Brazil, Russia, some of these bigger ones, they held up better because they had bigger reserves. And I think going forward, the interesting question will be as we enter this dollar weakening cycle, will they re up their US debt? I think there's a good chance they won't as much as prior cycles. And that'd be more of a persistent change toward a more multipolar world. So far, in the past few years, we don't really see much growth in dollar-denominated debt. And then, really going back to 2009, the global financial crisis, there has been a shift in reserve asset policies, which is to say, for decades, central banks' holdings of gold was decreasing, and that pivoted in 2009, started going back up. And of course, certain things like 2022 accelerated it, but that's been a change that's been happening for 15 plus years now. And I think that trend has room to go. And around the margins, we see some countries holding Bitcoin, like El Salvador or the Kingdom of Bhutan. It's still a small, volatile network, but that's another neutral reserve asset that countries can hold. And so I do think we're very gradually, and again, this is a huge network effect that takes time to change, but I do think we're entering a world where reserves are more diversified than just dollars. And more trade agreements can happen outside the dollar-based system, primarily with, say, Chinese currency, and maybe a handful of others. Basically, instead of just being one global reserve currency, we can shift toward a somewhat more multipolar world where there's like three major currencies plus a higher usage of neutral reserve assets.
And maybe a euro. I don't know. Let's now move on to just a few words about Europe, which has a very singular situation regarding currency, obviously, because we have a common currency between different countries, and no common fiscal policy, no common government, which is very unique. The European Central Bank is now deep into its pre-launch phase for what they call a digital euro. So we had a rule book that was updated in April, and a full-scale pilot penciled for something like late 2025. Governor Lagarde is pressing to accelerate the roadmap, whereas in the US, basically Trump said, I don't want to hear about anything about CBDC. So there's a big gap between those two regions, and the ECB board members, they also pitched the project as a way to defend monetary sovereignty against dollar-backed stablecoins. And you mentioned also about kind of multilateral currency world, and also to modernize Europe payments rail. But in Broken Money, you warned that central bank digital currencies, so CBDCs, they can hand governments absolute control over transaction and threaten especially privacy. From your perspective, do you think those motives that are mentioned by the ECB board members and Governor Lagarde and so on, are they more about giving the central bank finer grained control about the ledger, the bigger ledger, let's say?
Yeah, so go back to the prior point of the question. I do think that the euro is one of the top three currencies that has the capability to be its own regional currency block. In many cases, already has, especially cross-border financing and usage within the eurozone, and then a little bit outside of it. So really, the dollar, the Chinese currency, and the European currency are the three regional hubs for currencies. After that, there's a sharp drop-off between other currencies. Even safe haven ones, like the Swiss franc, for example, are just low in usage because it's a smaller system. And yeah, as you point out, the issue with the euro is that while the currency is unified, the fiscal situation is not, and then by extension, the bond markets are not. So in the U.S., when entities hold dollars, they can invest it in treasuries or really liquid like Mag 7 stocks, for example, and they have these big multi-trillion-dollar markets with very liquid things that they can buy and sell. Whereas in Europe, that capital market is more fractured. So outside of German bonds, it's not super attractive to outside entities. You have all these kind of fractured bond markets, fractured equity markets, and China has a similar problem because they have restrictions on their capital outflows. They don't emphasize their stock market as much, so there's less global demand for their stock market, and
And
they are trying to
less guarantees also on private property, probably in China.
weaker rule of law, and then they are trying to internationalize their bond market with some degree of success, but again that takes time, and so the euro and the Chinese currency still have disadvantages relative to the dollar, even as that might be shifting over time. If the U.S. becomes less rule of law based and China keeps emphasizing the solidity of its bond market and gradually opening up some of its capital markets, they can start to compete. Going back to the euro CBDC thing, this is kind of the ultimate end state of fiat currency. which is that instead of just surveilling everything on the bank level, they can surveil everything on the individual level. And I mean, Christine Lagarde's been pretty open with her goals on this. I mean, I believe in France, what cash transactions are limited to €1,000. Otherwise, you're on the black or
Yeah,
gray
they have
market.
been limited to €1,000 for the past 10 years, I think.
Yeah, and so that's specifically to try to go after privacy. And when Christine Lagarde was talking about this kind of thing, she would reference individual acts of terror and say, well, it's because of an anonymous money that they were able to do this. So you kind of point to individual circumstances. Of course, those are tragedies, but you point to these one little things in this country of tens of millions of people and say this is why nobody can have privacy now.
Just for context for the audience about the situation in France, we just had a law that is currently being voted into application, which is the fact that now if you're trying to preserve your confidentiality with crypto, there's a presumption of guilt. So you're guilty of money laundering until you prove that you're innocent, and it's a presumption of guilt that's in the law. So it just has been voted in the National Assembly just a few days ago.
Yeah, and I think that is a power reach. And the steelman argument, if you were to put themselves and say the most ethical person that has that view would say, in a world of danger where increasing technology gives individuals a lot of power to do harm, we have to surveil everyone to minimize harm that's happening. Whereas, of course, the pushback against that would be to say, the taking away individual liberties, taking away privacy is itself very harmful. And even values that are now more widespread in France, if you look at say developing countries, many of them, you say, well, if you took the same policies and put them there, how would the government use them there, right? So, for example, freedom of the press. I mean, there are people that just get their bank accounts frozen in different countries for what they said or what, things that they did that were not a crime or that are a crime that are not crimes in other nations, right? That we wouldn't think of as crimes, like speaking against the crown or something. And so that is the risk of CBDCs, is that it gives kind of ultimate power to authorities to surveil and therefore control practically everything. And so I think it's hard to enforce. That's the thing. So, for example, when you control banks, that's easy to do. All banks have to just comply with whatever the government says. Whereas if you try to enforce these things on the individual level, that partially depends on how good they are at convincing the population to go along with it, and then what percentage of the population is willing to take risks to disobey it. Kind of like if you ban marijuana, it's not as though marijuana disappears from the country. There's some percentage of people that use it on the black and gray market. And a similar thing's true for things like privacy, especially when technology like Bitcoin and other layers and other cryptos allow for privacy. There are some percentage of people that use it. And then especially if the euro encounters, ongoing inflation or currency weakness, then it's hard to keep selling to the public. No, you have to use our highly surveilled, centralized, debasing ledger. You can't use those other ledgers.
And there's no
So
escape from that. From the
yeah,
moment it's put on the individual level, there's no escape from that situation. Yeah.
yeah. Other than broad kind of disobeying, like civil,
Yeah.
kind of protests and things like that. So we'll see how Europe goes.
Or maybe, and that's the last part of the conversation that we can have today, maybe one of the escape is also Bitcoin, of course. And you introduce in your book Bitcoin as one of the most promising path to solve our broken money system, even though it's not one yet, because it could very well, fail. It could be a bug. There could be something. So maybe two or three last questions. But the first one is, could you please say why you think it's a very promising path to solve that broken system?
So Bitcoin represents the first credible way to make fast settlements. So it closes the 150-year mismatch between light speed transactions ever since the telegraph was adopted and settlements. So we can now do global settlements, in 10-minute block times, even faster with like the Lightning Network and certain other L2s that give similar degrees of assurances. And so you don't really need a centralized ledger to transact anymore. I mean, a really good example was, I was sending a wire transfer last week, and the bank blocked it, so I had to get on the phone with them, and then we sorted it out, and then they they blocked it anyway, so I had to like call a second time. So I went through this 5-day process of sending a wire for a startup company investment, and there's no one that could stop me from sending Bitcoin. So it's this ledger that works outside of that kind of centralized top-down system. For 16 years in running, Bitcoin is the largest, most liquid, biggest network effect. So we talked before about how monies have network effects. Bitcoin is by far the biggest one. It's kind of the simplest and most robust one. So it's got the kind of the lowest attack surface. It's got the kind of among the lowest complexity, which kind of optimizes it for this kind of robust nature. But the downside is it's still under 2 trillion market cap. It briefly touched 2 trillion, but it's currently a little under 2 trillion, and it's going up against a 100 trillion plus fiat system, several hundreds of trillions when you take into account broad money supply, bond markets, all these kind of things that are tied together, and state control. So it's got this kind of uphill battle to go against, but it is kind of the first credible solution at scale to kind of get around this problem and give people choice. And an example that I use is that before Bitcoin, 160 plus currencies in the world, and everyone has a pretty tight monopoly over their borders, which is to say the only two ways to get money in or out of a country are one, wire transfers, which are controlled by the state and the banking system, or two, physical ports of entry, which are highly surveilled and confiscatable. And now anyone can bring dense value with them by memorizing 12 words or writing 12 words down in your luggage somewhere. Good luck trying to find that. And now there's kind of infinite value density transfer. If I have a freelancer do some work for me in Nigeria, let's say she makes some graphic art that I want to use, she can hold up a QR code on a video call or in a DM, and I can pay her uh, outside of kind of these big centralized systems. And so that opens up all sorts of that kind of re-empowers the individual. And then it comes down to, what percentage of people are going to use that power. Is it going to hit a critical enough scale as kind of attempted crackdowns occur? There's been interesting attempts where India would try to ban it, and then their legal system would kind of flip-flop on it. In the U.S., we have certain administrations that are against it. Even Trump himself was against Bitcoin, but now Bitcoiners are pretty wealthy, and they can lobby politicians, and they can also say, well, there's really no upside for you winning an election to be anti-Bitcoin or broadly anti-crypto. There's very few marginal votes you're going to get from that position, but there are single issue voters, and there are big donors that will fund your opposition if you're explicitly anti-Bitcoin or anti-crypto, or even kind of neutral on it. And so the game theory is relevant when you start to hit this kind of scale that we're at. And so yeah, I think that there's a brighter world of open source money. It remains to be seen how successful it's going to be, but 16 years and counting, it's successful. Ironically, I mean, right now the biggest global settlement ledger is Fedwire. Every year they settle, and it sounds funny, but it's not. It's $1 quadrillion in value, so 1,000 trillions in gross
That's a lot
settlement
of
volumes.
zeros.
Exactly. Bitcoin is in the low tens of trillions of settlement value. And ironically, Bitcoin's had higher uptime than Fedwire throughout the last 10 years. So this decentralized open source network has a higher uptime than the leading alternative, and it's permissionless, it's decentralized, and we'll see how it goes.
So, two last issues. One very small is the environmental issue, and the second one is more about the transition period. Um, from the environmental perspective, I think it's not very much talked about because when we talk about environment Bitcoin, most debates go around mining, basically operational. But my take on it is that actually it fits better as a currency system with the current environmental concerns. Being a currency that favors long-term time preference, allows saving for everybody without being punished by inflation, reduce waste and malinvestment, also favors stricter handling of public finances and deficits. Is it a vision you agree with, or is something that you think that's marginal?
So I agree with it. I mean, nature has scarcity to it. So I think it makes sense that scarce money aligns with nature more so than kind of debasable money,
Infinite, yeah.
infinite money. And when we get specifically into the Bitcoin mining aspect, this is where I see a lot of non-technical people kind of misunderstand this, or in some cases use it even consciously. When you look at electricity production, a lot of it is wasted. Electricity is not very fungible. It can only be transported and stored so much without major losses and just curtailment. And Bitcoin miners, because it's so hyper competitive, they have to seek out the lowest cost electricity, which is mostly stranded or wasted electricity. And so they actually can over time help the grid. And people take these isolated pockets of Bitcoin in its kind of early phase when it goes through a 10x price change. And sure, there can be little disruptions then because you have these kind of weird market dislocations of this new asset. But as the asset matures, Bitcoin miners kind of have to settle into all the little crevices and all the little inefficiencies around the world. And then even, I mean, World Bank estimates that there's like, when you look at all of the flared natural gas in the world, so whenever miners, oil producers get oil out of the ground, it often comes with a little bit of natural gas. And if it's only a little bit, they can't build a pipeline to make use of it. And so they literally just light it on fire. That's literally what they do with it, or they just vent it into the atmosphere. Either way, it's greenhouse gases. And Bitcoin miners can, you can bring a little trailer of Bitcoin miners and a little generator and soak that all up and put it to economic use. And that's World Bank estimates that's something like 8 times the electricity needs of the Bitcoin network currently, the wasted natural gas. And so Bitcoin is this tiny rounding error on how much energy is just wasted in the world. And it can soak some of that up over time. So yeah, I'm not worried about the negative environmental impacts, and yet I am optimistic about some of the positive environmental impacts should we transition toward a more natural scarce money.
And for the audience, I might link to the episodes that we did with Daniel Batten and Kenji Tatewa on those topics where we had longer discussions on that. So as I said, last question about the transition, because that's an issue I have even with myself when I think about it. Like most Bitcoin enthusiasts, they have no trouble envisioning a future system with Bitcoin as sound money for the world. I, for myself, have troubles envisioning the transition because I can't see any scenario where the world wouldn't have to go through a deep crisis to change system because we mostly have been living above our capabilities for the past, let's say, 50 years. Is there a way we can transition to the Bitcoin system peacefully? Or is it something that is impossible to sell, let's say, politically speaking?
So I think the process is inherently going to take decades. I mean, it's already 16 years and counting, and it's still only made a tiny dent. In order for this network to become a tens of trillions of dollar network and to start meaningfully displacing even some of the large developed currencies, that is inherently a multi-decade phenomenon. Should it even be successful? And probably the closest example is when you have emerging markets go through series of crises and gradually get dollarized, which is to say that despite top-down attempts to try to keep their currency, they become so impaired that the dollar just kind of the bottom up, just kind of people start using the dollars around them, and that could happen to developed countries over time with Bitcoin. As these kind of fiscal imbalances keep growing, and as Bitcoin becomes a larger and more stable network, it becomes a pretty credible challenger in a similar way that the dollar is a credible challenger to all these kind of long tail of weaker currencies. That's still a ways off, I think. But generally speaking, probably the best case scenario is you have a multi-decade transition that's punctuated by occasional crises, but those crises are individually manageable. So they're not like these catastrophes; they're just crises.
Nothing
Um,
systemic. I mean, every time there's a crisis, we put even more money in the system, and so we solve the crisis, but we add systemicity to the whole system.
yeah, I mean, a series of defaults and debasements are going to keep happening. Politicians will choose what ratio of defaults or debasement they want. They generally err toward debasement, but that'll kind of gradually, I think, keep happening over time. It'll happen in clusters because these things do. Um, and the ones with the biggest imbalances are the ones that have the most to lose, and the ones with the least imbalances or that the imbalances are against them have the most to gain. So if we do, for example, have a dollar crisis, that can be bad for a lot of Americans. That can be bad, especially for people in Wall Street and DC and stuff. But that can be good for Brazil. That can be good for Turkey. That can be good for entities that are dollar indebted around the world. That can give them a boom, which ironically could pull America out of it. I mean, kind of like how the BRICS led the 2000s kind of economic growth cycle. They could lead the late 2020s or they could lead the 2030s growth cycle because in this kind of interconnected system, one entity's weakness, especially America's weakness, to some extent, is a boon for others, which then can circle back help the US. We see a similar thing where when the dollar strengthens, that sounds really good for America, but then when it pressures all those kind of emerging markets really hard, that ricochets back and hurts global growth and therefore hurts American growth. So the opposite can happen where weakening dollar can give us inflation, can give us political crisis, can give us all sorts of issues, but then when China's booming or Brazil's booming or Turkey is finally doing well for a change and all these and Europe's maybe doing a little better, that can over time ricochet back into the US. So there are ways I think to get through this. It's any sort of political changes and kind of economic changes and regime changes are messy, kind of like how the 70s was messy, the 1930s was messy. I think the biggest thing is to avoid major wars and to avoid
Yeah,
major kind of dislocations and social breakdowns.
because you have a long running meme on social networks. Nothing stops this train. Do you think it's an optimistic or pessimistic train that's coming?
Um, it's a mix of both. So the nothing stops this train refers to U.S. fiscal deficits, to a lesser extent other deficits in the world, but especially U.S. fiscal deficits. And the optimistic part of that meme is to basically say that when the train gets derailed, that can either be through massive deflational collapse or hyperinflation. And to say that nothing's stopping this train for a long time is to say neither of those two extremes are going to happen anytime soon. So at least into the 2030s, I think we're going to be in a state of above average debasement, but not catastrophic debasement. I think that the system unwinds in this kind of gradual way, punctuated by many crises along the way, and that's going to keep happening. I think. We'll see what happens by the 2030s. That's where it's probably start to get messier, and I'll kind of adjust my view as we go forward. But basically, I think we're on this ongoing track of fiscal debasement, random crises, and growth of neutral reserve assets.
Thank you very much, Lyn, for this discussion. Before we let you go, where can people follow your work?
People can find my work at lynalden.com, and they can check out Broken Money wherever books are sold, Amazon, whatever major places to buy it in France are, now that it's coming out in French.
Yeah, it's coming out in French at Consensus Network editions. And thank you, everyone, for being with us on this episode. I hope you liked it. Don't forget to, of course, subscribe if you liked the episode. Thank you, Lyn, again, and bye. See you soon.
Thank you.